Hey, good morning, everybody. This is your market update for Thursday, September 22nd. Hope everybody's having a great morning so far. Stock market yesterday did not have a great day. They did not like Jerome Powell, the Fed chair's comments at the culmination of their meeting over the course of the last couple of days. As far as the rate hike goes, it was exactly what was anticipated, a 75 basis points hike. But he made some pretty aggressive comments again in regards to their continued fight on inflation, and that they're going to continue to be aggressive to get the inflation figures back down to their target rate of 2%. So the stock market sold off hard, closed down on the Dow over 500 points yesterday. S&P 500, NASDAQ closed down as well. Today, the stock market, the Dow is down, but only 73 points last I checked. So it seems to me that it's settled a bit after yesterday's rout. But mortgage-backed securities yesterday initially sold off pretty hard after the comments came out, but actually came back and gained a lot of what they had lost. Today, on the other hand, is a different story. Down 63 basis points last I looked, so it's certainly not a good day in the mortgage-backed security market. I'll let you know what the 30 and 15-year published rates are for Freddie Mac. I'll let you know what those are tomorrow and just give you a gauge of what the increases that have occurred from last week to this week, because I know that there's been some further increases as well. So I wanted to point out, the inflation issue is not just an issue here in the United States. A lot of global counterparts, global banks, Bank of England, Swiss Bank, a lot of other banks actually followed suit with the Federal Reserve and raised their the equivalent of their Fed funds rate. So it's a global inflationary issue. It's not just here in the United States. And so the multiple countries, globally are trying to fight inflation and bring it back down into a reasonable, acceptable range without spurring a recession, which is not an easy task, but the Fed's doing the best they can using their resources. From a mortgage rate standpoint, I think in the short term, we're suffering a little bit with higher rates. But as the Fed takes their action and is aggressive, the hope would be is that brings inflation down sooner than later, and that mortgage rates will actually follow suit and come back down sooner than later. So I'm not necessarily opposed to an aggressive Fed stance. I think the problem is that, monetary policy, it lags a little bit with its impact. And so as the Federal Reserve raises the Fed funds rate, it usually takes a few months for the impact of those increases to affect the economy. So I think a lot of people were concerned that the Fed is acting too aggressively, and by the time the impacts of the increases actually hit the economy, that it's likely to put us into a recession. And I think that's why ultimately the stock market reacted the way that it did yesterday. So we'll wait and see, obviously, what happens. I think the Fed has, some room or some supporting factors at this point in time, with inflation numbers continuing to not really decrease so much. I think they have the stance where they can continue to be aggressive or justify being aggressive. So next meeting with a proposed rate hike is going to be in November, and I think the markets are probably pricing in another Fed funds rate increase. Not sure if it's 50 or 75 basis points. We'll have to wait and see. But sorry for the super long rambling message today, but I just wanted to kind of give everybody some backstory on what's occurred and why. So as always, here to help, here to answer any questions. Feel free to reach out to me at any point in time, and I will update you again tomorrow.